Hey everyone, welcome back to Wealth Intel Report. Ever felt that jolt of anxiety when you see a red market headline? Or that rush of excitement when a stock you own shoots up on some news? That, right there, is the core of what we're talking about today. We're pulling back the curtain on the psychology of investing, specifically, the behavioral biases that cause us to overreact to every single piece of market news. And trust me, understanding this is more crucial than any stock tip you'll ever hear. Let's start this journey by riding the emotional roller coaster. So, why does a headline about interest rates or a company's earnings report feel so visceral? It's because your brain, that amazing organ built for survival on ancient plains, hasn't quite caught up to the modern stock ticker. When you perceive a threat to your financial security, like a looming market drop, your brain activates the same primal fight or flight response it would use if you encountered a predator. Your amygdala sounds the alarm. Stress hormones like cortisol and adrenaline flood your system. Your heart rate increases, and your focus narrows to the perceived danger, that plummeting number in your portfolio. This is biological, not logical, and it happens to seasoned Wall Street veterans just as much as it does to a beginner. The screen in front of you might as well be a rustle in the tall grass to your primal mind. Let's make it concrete. Think about recent memory. Recall the panic during the early COVID crash or the sharp swings whenever the Fed announces an interest rate decision. Remember the visceral reaction to a major tech giant missing its earnings projections by just a few percent? And what do we see in the market? Immediate, often wild, and disproportionate price movements. A stock might drop 10% in minutes on a piece of ambiguous news, only to recover half of it by the afternoon. That initial swing isn't about cold, hard valuation. It's a pure pulse of collective emotion, a wave of fear or greed washing through millions of amygdala-driven decisions all at once. We are reacting to the headline itself, not the long-term implications. This creates a feedback loop of stress. It's a self-reinforcing cycle. The critical thing to understand here is that this initial emotional spike is noise. Your job is to recognize it for what it is, a biological alarm bell. Before you hit the sell button or frantically buy the dip, you must pause and engage the smarter, slower, more analytical part of your brain, the prefrontal cortex. You have to let the emotional wave crash and recede before you even think about making a decision. Because if you act on that raw emotion, you're playing right into the hands of every bias we're about to discuss. You become part of the volatility, not a strategist navigating it. The first step to winning the investing game is to understand that the roller coaster is happening inside you. Once you know you're on a ride, you can choose to strap in and wait it out, instead of screaming to get off at the very bottom. If this is making sense so far, you're already ahead of the crowd. Help us spread this crucial knowledge. Take a second to smash that like button, and subscribe to Wealth Intel Report for more deep dives that protect and grow your wealth. Up next, we dive into the specific mental shortcuts your brain uses that make this emotional reaction so much worse. Welcome back to Wealth Intel Report. We're on a mission to disarm the mental traps that cost investors money. Now that we understand the emotional engine driving our reactions, let's look at the first two specific biases that create a dangerous illusion of control: confirmation bias and recency bias. These are the filters your brain slaps on every piece of news you see. This is our deep-seated desire to seek out, favor, and remember information that confirms what we already believe, while ignoring or dismissing anything that contradicts it. Think of it as your brain's own echo chamber. If you've bought a stock because you believe in the company's future, your brain goes on a mission to prove you right. You'll naturally gravitate towards news articles, analyst reports, and forum posts that are bullish. You'll give that information more weight. That glowing analyst upgrade? See, I told you I was smart. That worrying article about new competition? Oh, that's just a hit piece. Or that's already priced in. You're not doing this maliciously. It's an automatic, subconscious process to avoid the psychological discomfort of being wrong. The danger is that it blinds you to real risks. You become overconfident, holding on to a position long after the fundamentals have changed, simply because you've curated a world of information that supports your original thesis. Now, pair that with its powerful partner, recency bias. This is our tendency to weigh the most recent events, the latest data points, and the current news cycle as far more important than historical trends. Our brains are wired to pay acute attention to what just happened because, in evolutionary terms, the rustle that just happened is more immediately relevant than the rustle from last week. In the market, this is devastating. Picture a stock that's been in a beautiful, steady uptrend for 18 months. Then, this week, it drops 8% on some sector-wide bad news. Recency bias screams that this new drop is the only thing that matters. The 18-month trend fades into a distant, irrelevant memory. The pain of the now dominates your thinking. It feels like the entire story has changed, that the trend is broken forever. This leads to selling at lows, right before a rebound, or panic buying into a hype-driven bubble simply because it's been going up for the last few weeks. You're extrapolating the immediate past infinitely into the future. Let's create a hypothetical scenario to tie these together. Imagine tech giant Incorporated has been your winner, climbing steadily that you're confident. Confirmation bias has you reading all the positive projections. Then, one Thursday, they announce a product delay. The stock drops 10% in a day. Recency bias hijacks your mind. The delay feels catastrophic. The past year of gains evaporates from your emotional memory. You might even seek out commentators, confirmation bias in a negative direction now, who are predicting doom, validating your new fear. The long-term story of the company, its patents, its market share, its cash flow, gets completely drowned out by the loud, recent bad news. This is the illusion of control. You think you're making a reasoned decision based on new data, but you're actually being puppeteered by these two biases working in tandem. The antidote: first, actively seek out disconfirming evidence. For every stock you love, read the bear case. Challenge your own assumptions. Second, always zoom out. Look at the 1-year, 5-year chart. Force your brain to contextualize the recent event within the long-term trend. Ask yourself, has the fundamental story changed, or is this just new noise? Breaking these biases requires deliberate, conscious effort. It's the work of a disciplined investor. If you're finding these insights valuable, please share this video with a friend who invests. Sharing helps build a community of smarter, calmer investors. Now, let's examine the powerful force of the crowd and the numbers that haunt us. We're back on Wealth Intel Report, building your defense against irrational investing. We've covered the internal emotional engine and the biases of perception. Now, let's step outside and look at the powerful social forces that shape our decisions. The herd mentality, fueled by social proof and anchoring biases. This is about why we follow the crowd, even when it's heading toward a cliff. First, social proof. It's a fundamental principle of human psychology. When we are uncertain, we look to the actions of others to guide our own behavior. It's a survival shortcut. If the whole tribe starts running, there's probably a good reason, so you should run too. In the hyper-connected world of modern investing, social proof is amplified to an insane degree. You see a stock crashing with volume spiking. Your broker app shows top movers with huge red percentages. Your social media feed is flooded with people saying, "The sky is falling," or "I'm getting out now." This creates an overwhelming signal that says, everyone is doing this, so it must be correct. The fear of missing out on the right move, or the fear of being the only one left holding the bag, becomes unbearable. So we sell into the panic, often at the worst time. We become part of the stampede, amplifying the very volatility we fear. The same happens in reverse during a bubble. Seeing everyone get rich on a meme stock or crypto coin creates a FOMO-driven rush to join. Logic be damned. This herd behavior is often directed by a powerful, hidden force, the anchoring bias. In investing, the most common anchor is a price. Maybe it's the price you paid for a stock. Maybe it's the 52-week high you saw on the chart. Maybe it's a round number like $100. That number gets stuck in your head and becomes your reference point for all future decisions. If the stock is now at $70, your anchored brain thinks, it's so cheap compared to $100. You're not evaluating the stock's current value based on its present fundamentals. You're obsessing over its relationship to an arbitrary past number. You hold on to losers hoping to break even, ignoring new negative data. You sell winners too early because they've hit your anchored, high price target, leaving future gains on the table. Now, think about how financial media and influencers, often unintentionally, exploit both these biases. A headline screams, "Stock X plummets 25% from its high." That headline is setting two anchors: the high price and the dramatic loss. It's also broadcasting social proof of a panic. An influencer yelling, "Everyone is buying this AI stock right now," is pure social proof. These external voices become the anchors and the herd's signal, short-circuiting your own analysis. Your decision-making becomes a reaction to their anchors and their crowd, not your own research. To break free, you must identify your anchors. Write down your thesis for buying an asset independent of its price. What fundamentals would have to change for you to sell? If the price is down but the thesis is intact, the anchor is lying to you. To counter social proof, practice contrarian thinking. When the sentiment is overwhelmingly fearful, ask what might go right. When it's euphoric, ask what could go wrong. The goal isn't to always be opposite the herd, but to never be part of it just because it's the herd. Your portfolio's success depends on your independent judgment. For more tools to develop that independent judgment, make sure you're subscribed to Wealth Intel Report. Next up, we tackle the two heaviest hitters, the deep fear of loss and the stories that shape our reality. Welcome back to the crucial, core chapter of our discussion here on Wealth Intel Report. Now, let's get to the absolute heart of the overreaction problem, the powerful twin engines of loss aversion and the availability heuristic. This is about the raw psychology of pain and the stories we tell ourselves. First, loss aversion. This is the crown jewel of behavioral economics, and it states a simple, profound truth. The pain of losing a sum of money is psychologically about twice as powerful as the pleasure of gaining the exact same amount. It's why the sight of a portfolio dipped in red is so uniquely agonizing. When negative news hits and prices start to fall, loss aversion roars to life. This primal urge to avoid the emotional agony of a realized loss is what drives panicked selling at market bottoms. You're not selling to maximize future returns. You're selling to escape the present psychological torment. You lock in a paper loss to end the feeling of loss, which is often the worst possible financial decision. This panic is supercharged by the availability heuristic. This is a mental shortcut where we judge the probability or importance of an event based on how easily examples come to mind, how available they are in our memory, and what kinds of memories are the most vivid and readily available: dramatic, scary, emotional stories. The 2008 financial crisis, the 2020 COVID crash, the story of your uncle who lost his fortune in the dot-com bubble. Those narratives are seared into your memory. They play like movies. On the other hand, the slow, steady, boring compounding of the market over decades, the fact that, despite crashes, the S&P 500 has always reached new highs, that's not a dramatic story. It's a bland statistic that it's not available. So, when ominous news breaks, your brain doesn't consult the historical chart of long-term gains. It immediately pulls up the vivid, terrifying movie of the last crash. You overestimate the likelihood of a total meltdown because you can feel the memory. The current news feels like the opening scene of that same disaster film. Together, loss aversion and the availability heuristic create a perfect storm of overreaction. The news triggers a vivid, available memory of past pain, availability heuristic, which amplifies the immediate fear of experiencing that pain again, loss aversion. You're not just reacting to the news. You're reacting to the entire, horrifying story your brain has instantly constructed. This turns rational investing into a desperate, reactive gamble. You hop out of the market to avoid the feared loss, often missing the subsequent recovery. You become your own worst enemy, buying high out of FOMO and selling low out of fear, trapped in a cycle dictated by psychology, not finance. Recognizing this is your power switch. When you feel that gut-wrenching fear to sell, you must pause and say, "This is my loss aversion talking, amplified by scary memories. What does my plan say? What do the long-term fundamentals say?" You must consciously bring the boring, long-term data to the front of your mind to compete with the available, dramatic story. It's the hardest work in investing, but it's the work that separates the successful from the reactive. If this video is helping you in that work, please let me know by hitting that like button. It really supports the channel. Now, let's put it all together and build your practical, bias-proof action plan. This is Wealth Intel Report, and we've reached our final, most important segment, your actionable playbook. Knowing your biases is the diagnosis. Now, here's the treatment. These are the practical, concrete strategies to build a rational investing process that withstands the storms of emotion, news cycles, and herd mentality. Let's conquer these biases together. Strategy 1 is non-negotiable. Create a written investment plan. This is your constitution. It must be written before the next market crisis or euphoric bubble. Your plan should define your long-term financial goals, retirement, a house, etc., your target asset allocation, what percentage in stocks, bonds, etc., your criteria for selecting investments, and, critically, your rules for selling. What constitutes a fundamental change that warrants a sale? Is it a specific drop in earnings? A change in management? Define it. When the news hits and emotions surge, you don't make a decision. You simply execute the relevant part of your plan. This document physically separates your logical, long-term self from your emotional, present self. It is your anchor against anchoring, your shield against recency bias. Don't let your financial future depend on the news cycle of one company, one sector, or one country. A globally diversified portfolio across different asset classes, stocks, bonds, real estate funds, is your ultimate anti-panic mechanism. When bad news hits tech, your healthcare and consumer staples holdings may hold steady. This smooths your returns and, more importantly, your emotional experience. You'll never see your entire life savings flash red, which keeps loss aversion in check. Diversification isn't about maximizing returns in a boom. It's about preserving sanity and capital during a bust, so you can stick to your plan. Strategy 3. Conduct an honest audit of your personal risk tolerance. If a 20% market drop would cause you to abandon your written plan, then your portfolio is too aggressive for your psychology. There is zero shame in a more conservative allocation. The best portfolio is the one you can hold through a bear market. Adjust your portfolio so that market volatility feels uncomfortable but not catastrophic. This self-knowledge is a superpower. Finally, strategy 4. Engineer your environment for critical thinking. This means curating your information intake. First, limit your exposure to financial media. Their business model is built on your clicks, which come from your fear and greed. Schedule 1 or 2 times a week to check financial news, not every hour. Second, deliberately seek out high-quality, varied sources. Read annual reports, listen to earnings calls. Follow thinkers who challenge your views. Third, automate your investments. Set up automatic contributions to your portfolio. This enforces discipline, removes emotion from the buying process, and leverages dollar-cost averaging, which is inherently anti-timing. Remember, your greatest edge in the market is not secret information. It's a calm, disciplined mind. You will never eliminate these biases. They are part of being human. But you can build systems that render them powerless. You can recognize the emotional roller coaster and choose to stay seated. You can notice the herd and choose a different path. You can feel the fear of loss and choose to consult your plan instead of your panic. If this deep dive into the psychology of wealth has been valuable for you, please help us out. Hit that like button, subscribe to Wealth Intel Report for more content that builds your financial intelligence, and share this video with anyone you care about who invests. Together, we can build a community of smarter, more resilient investors. Thanks for watching, and invest wisely.